Hello, chart watchers, and welcome to this Tuesday, July 31st, Market Watchers Live Show with your hosts, Tom Bowley and Mary Ellen McGonigal. Aaron Swinlin is off today, and we'll return to Market Watchers Live tomorrow. For those of you joining us for the first time today, welcome to the show, and for our regulars, welcome back. Well, market trying to recover from its recent selling, and it's doing so far today. The Dow Jones Industrial Average up 151 points, the S&P 500 up 18, the NASDAQ up 63, and the Russell 2000 up 17, more than 1%, and leading the market on a relative basis today. The 10-year Treasury yield is down a couple of basis points to 2.96%. Volatility pulling back after trading at its highest level, closing at its highest level in about 3 weeks yesterday. We are pulling back a little bit today. The XLI, let me see, here we go. The XLI is higher by about 2% today, leading the market to the upside, trying to break out above a key level. I'm going to talk about industrials quite a bit in just a little while. Financials down today, though. It also is challenging a key area of resistance, and this is kind of unusual. These two have been running either together to the upside or to the downside mostly over the last couple of years, but you can see industrials leading the market today, financials trailing. Stocks in the news, mostly on earnings. You got KLA-10 Core trying to make a breakout to the upside after posting very strong results and raising their guidance. Illumina also nice move today, up 29 points, nearly 10%. Charter Communications trying to make a breakout on its earnings. And then finally, Qualcomm, they came out with a Dutch auction tender. And as a result, and I think that was for $10 billion worth of stock, which is about 1/3 of what they're looking to buy back under their stock purchase program. And Qualcomm up 3.5% today on that news, breaking above the level just a few days ago with its earnings. Okay, Mary Ellen, it's Tuesday, second day. By the way, welcome back. Had a great time.
Yes, thank you. It's great to be back.
And we got a big earnings report coming out tonight. I think you've heard of them, haven't you?
I heard a little bit about them. I think they make some iPhones or something like that.
Yeah, something with computers.
No, it's the big kahuna, and I know a lot of people on the street and elsewhere are down on their knees hoping that this A part of the FANG swoops in and at least saves the day.
Yeah, this is going to be a big one. You know, we had Facebook dropping a bomb, that part of the initial part of the FANG, dropping a bomb last week with earnings. I don't think the market would be able to take it from Apple.
You're right. There are a lot of people out there that think that this could be the proverbial nail in the coffin if they whiff at all. So all eyes on Apple.
Yeah, and we've got a poll in the room. I just want to make sure everybody's aware of it. Just just everyone's take on what you think of Apple. They aren't far from being the first $1 trillion company. I think they're 940 billion or nine. I haven't looked recently. Maybe 950. Maybe Mary Ellen, but somewhere in that neighborhood. So
very close. It's the big number that everyone is talking about.
Yeah, so if they get a 5%, 6% pop with earnings, I mean, they're going to be right on the threshold of being that first $1 trillion company. But anyhow, I just wanted to point that poll out to everyone. Check that out. Let us know what you think. You think Apple's going to just sail past its earnings estimates? Do you think we're going to struggle for a little bit? You think the overall market's overpriced and we're going down no matter what? You don't care? We'd just like to get your opinion on that, see what you think. So chime in on Apple and what you think in the poll today. All right, well, we got a really busy schedule, and so I'm going to go ahead and jump right into it. Let's talk about some of the upcoming things that we've got later this week. We've got Decision Point Monthly Review. Erin will be back tomorrow, so she'll be going over that in another day or so. We got Bruce Frazier joining the show on Thursday. Always great to talk to Bruce and get his latest on Wyckoff and what he's seeing in the market. And can't stress this one enough. Next week, I cannot believe that I'm saying next week, but the latter part of next week, next Friday and Saturday, August 10th and 11th, ChartCon 2018 only comes every couple years. The list of speakers is amazing, Mary Ellen.
Yeah, it's certainly with much anticipation and a lot of excitement surrounding the whole event. It's just a wonderful opportunity to see a lot of smart people in one room and sharing their thoughts with you and certainly their experience. I mentioned yesterday that the timeliness as far as the subject matter, I think is just priceless, because we will be talking about shifts in the market and how to defend your portfolio and your stocks, and all of that is just going to be really critical, just given the general sense and feel for where we are in the markets right now. So lots of great information is going to be dispensed.
Yep. And the other thing, the most important thing for me is I can show up and tell Greg Schnell how wrong he's been for the last 2 years. I'm just kidding. I always give him a good time. We're great friends. But anyway, let's go ahead and go through the agenda for today. Mary Ellen's going to be doing her workshop. She's going to show you how she drills down to find some outperforming stocks, momentum stocks. That's going to be very interesting for everyone, I'm sure. We'll start the 10 in 10 today with Seagate Technology. I already have the 10 stocks picked out like yesterday. What I did was focus on big scooter movers among both or all the large caps, mid caps, and small caps. So most of these stocks are making big moves in one direction or the other. Be an interesting 10 in 10 today for sure. And then we'll wrap up with my August seasonality at the end of the show. So I'll tell you some of the things maybe you can look out for during the month of August. Okay, let's go ahead and jump in. There was a ton of economic news out today, so I'm going to show you the 10-year Treasury yield first. The reaction has been to the downside in the yield, meaning that money is rotating into the Treasury market. That normally is what happens when folks get a little bit more defensive. We had June personal income out this morning, rose 0.4%, exactly what the market was expecting. June consumer spending also rose 0.4%, exactly what the market was expecting. But May was revised higher from 0.2% to 0.5%. That's a pretty big revision to the upside, and consumer spending is roughly 2/3 of our GDP. So that's something at least noteworthy as we go forward, perhaps with our future GDP readings. But May Case-Shiller Home Price Index came out at, I think, 9 a.m. Eastern Standard Time, rose 0.2%, just shy of the 0.3 expected. July Chicago PMI out at 9:45 Eastern, 65.5, well above the 62.3 estimate. And then finally at 10 a.m., July consumer confidence came in at 127.4, slightly above the 127 reading. And after all of that, and with the FOMC meeting kicking off today and culminating in a policy statement tomorrow afternoon at 2 p.m., you can see that the 10-year Treasury yield really is just kind of taking it all in stride. I do think that we are in this uptrend, at least for now. To the downside, watch that rising 20-day moving average, and to the upside, watch this reaction high near 3%. So that is kind of going to be an area of consolidation that I would be watching to see which way we break on the 10-year Treasury yield. All right, today I mentioned earlier that industrials are leading. Take a look at the XLI. This is a really nice looking candle, and at this point, this would be the highest close that we've seen since mid-March on the XLI. I think that's very significant because not only are we seeing the XLI rise, but we're seeing it rise much faster than the S&P 500. And I'll show you a chart on that in just a bit. Taking a look at, say, the XLF rose right up near this key resistance area, and so far it's turning back down. So we've got both the XLI and the XLF coming up on key resistance, but so far the bulls are carrying the XLI higher. The bears, though, are having their way with the financials and pulling them back from key resistance. But both, if you go back and look, and this is what I was referring to at the open, they've been moving kind of together, both to the upside and to the downside, and they're both trying to break above March or break to their highest levels since mid-March, and yet they're going in different directions today. Kind of interesting. Thought I'd point that out. A couple of other key areas, the other two aggressive sectors, technology. Yes, we've been under pressure for the last 3 days, no doubt about it, but we got a clear uptrend. It's okay to have profit taking once in a while. It's just we don't want to get it to a point where we start seeing a lot of breakdowns and price support levels being lost, that sort of thing. I believe as long as the XLK continues to put in higher highs and higher lows, so therefore I think we've got a pretty big intermediate term support level around 68.5 on technology. We're seeing groups that hadn't been selling off for quite a while within technology doing so now. The software group, which has been on fire for a while, last 2 or 3 days, not so much. We've seen a lot of selling in software, but again, the overall uptrend does continue to remain in play. The final sector I wanted to show you, final aggressive sector, is the consumer discretionary group. And I think part of the problem here is we got a negative divergence. So as prices have been rising, you can see that the PPO has been falling. We gapped up just a couple of days ago. This would have been back on Friday. Looked like we were breaking to an all-time high, and instead we pulled back on the XLY, printed a bearish engulfing candle with a negative divergence in play. A lot of times that'll be a signal for some short-term weakness. We got that. I would be looking at the 50-day moving average, perhaps to unwind this PPO back to the center line, and possibly even to that low at the end of June, maybe around 108. Beyond that, I would be a little careful. This also lines up on the weekly chart on the XLY. Look at where the rising 20-week moving averages, and that has been pretty strong for the XLY as support over the past 2 years. That 20-week moving average is sitting at 107.80 right now, very close to the recent support that I just pointed out on the daily chart, and also very close to the breakout level that we saw back in January. So got a lot coming up around 107.50 to 108 if we see some additional weakness in consumer discretionary. So keep an eye on that. Let's go back and talk about the industrials for a minute, because there are 3 areas of industrials that I think look pretty strong here. But first, before I get into that, let's pull up the XLI versus the S&P 500. I want to go back a little ways here. First of all, let's get rid of the candlesticks. I like to use a line chart when I use relative strength lines. Let's go back 10 years throughout this bull market. Let's do a weekly chart, and let's take a look at the XLI, XLY. Now, one thing to note is that we have been essentially rising in relative strength on the industrial since the bull market began in 2009. It doesn't mean we go up every day, and I wouldn't look for it to go up every day. Money rotates constantly in the market between the major indices, between the sectors, between industry groups, between stocks. So it's okay to have pullbacks from time to time. I think what's interesting on the XLI on a relative basis to the S&P 500 is after consolidating here in this range for almost 3 years, we made a breakout, a relative breakout to the S&P 500. And if you notice where we came down to during the weakness over the past 4 or 5 months, we tested that relative support level, and now we're seeing money rotate back into industrial. I would not be surprised to see this continue. And now what I would do is simply get rid of this lower support line. We don't need that anymore. And this is what I would be looking at in terms of the XLI versus the S&P 500. So we're back in the middle. Clearly, we could go in either direction, but I do think the bias right now is to move into industrials. And so that could create some opportunities. So let's get out of this, and now let's take a look at these same charts, except this time let's look at the industrial, certain industries within the industrials relative to the XLI. So a couple key areas that I would focus on: railroads. If we pull up railroads relative to industrials, you can see over the past 2.5 years, railroads is where you want to be in the industrials. So if industrials truly are strengthening versus the S&P and money is rotating into the group, you want to keep an eye on these railroads, because railroads have been performing very strongly on a relative basis. Another group that I would continue to watch is the waste oops, that's not what I wanted to do. I wanted to show relative strength. But I would definitely keep an eye out for the waste and disposal services. And here you can see we've been downtrending for for 2 or 3 years, but the downtrend looks like it has ended and we're starting to uptrend here. Many of these recent uptrends have not lasted long, but anytime you're seeing money begin to rotate into the group, I think that is important. Also to note, we're very close to a relative support level where we're beginning to bounce. So I think we have a shot to run back up to this 4 level. It could mean some of the stocks within this space could continue to outperform in the near term. So that's this is a group to watch as well. The final group within the industrials that I would be watching very closely are the industrial suppliers. If you take a look at the DJUS DS, after downtrending for many years from 2012 to 2017, this was a group that was completely ignored. But as we've been rising here, notice that we are holding this rising 20-week moving average. We continue to outperform. This has been going on now for close to a year, probably under the radar because it had been the group had been under pressure relative pressure for so long. But this is starting to look like a pretty nice uptrend. And as long as this continues to trend higher, and if the industrials break out, this is going to be home to a number of stocks that I think could be interesting as well. So let's take a look at some individual stocks within these three industry groups. All of these stocks I'm about to mention all recently beat top line estimates and bottom line estimates. A few of these also raised estimates. So let's take a look at some of these. CSX, this is in the railroads. CSX Corp, huge breakout on very strong volume after a little bit of consolidation in June, early July. We made the breakout, continuing to push higher. If money continues to rotate into industrials, I would expect that CSX is going to continue to benefit. CNI, this one I'm not as big on. It's been doing very well, but I think on a relative basis, it's not performing nearly as well. One way I pull up these relative charts, and you can see what I'm talking about here. Here's CNI. Notice how back in May and June, the railroads had broken out above January high. CNI had not. And as a result, that's why we were seeing CNI underperform the railroads. We're starting to see a little bit of an uptick, though, in CNI. Technically, we look much better. So this is one they did beat top and bottom line, so I'm including it here. But I do like CSX better. And I also like NSC. This is Norfolk Southern. Also broke out recently. Railroads doing very well. NSC relative to the railroads just recently broke out above the high that we saw back in late January, relative high. And you can see the uptrend, relative uptrend strong here. And NSC relative to the S&P looks very strong as well. So those were three stocks within the railroads I think look good. Going to industrial suppliers, let's take a look at HDS. HDS recently topped estimates, top and bottom line. Stock looking pretty good. One thing you might notice is that HDS relative to its peers has been declining for the last month. That's a little bit misleading. The stock isn't really going down. It's been consolidating after a huge heavy volume breakout. I think this is a stock that could take off from the current level. You've got a group that's breaking out. Relative strength, I believe, will resume in the stock. And even though we've had a weakness relative to its group, I think HDS relative to the S&P 500 continues to perform pretty strongly. And then the other one that I like in this space is WW Grainger, ticker symbol GWW. This has been one of the best performers within the S&P, and you'll see this chart down here versus the S&P 500 just continues to be strong, even though it is in the industrials that have not been performing particularly well over the last several months, really in 2018. Look at what GWW has been doing. Each time earnings come out, they've been beating forecasts. They've been moving higher. Stock continues. It looks like right now it's trying to trade at a new high. Really good looking stock. And the last one in the waste and disposal services area that I wanted to bring up is CVA. CVA is, you can see here, breaking out again above the high that it had with earnings. Big volume. Here is the waste and disposal services index breaking out to a new high. Here's CVA, a little choppy on a relative basis to its peers, but I think clearly it has been trending higher. It's trending higher and broken out now versus the S&P. And the group, after downtrending for a while, looks like it is now breaking out versus the S&P. So anyhow, these were some ideas based on what's transpiring in the market today. And the fact that technology in pulling back, we're seeing money rotate into some other areas of the market. So I think industrials could provide some opportunities as we go throughout the next couple of months. And I know there were several earnings reports out this morning, Mary Ellen, and one stock that you had mentioned, Pfizer, PFE.
Yes, they came out with very good numbers and then revised estimates going forward. And that was a stock that I covered yesterday. And in that talk and discussing it, I don't know if it came up today, but they do have up to 15 new drugs that are in their pipeline that they're looking for approval. And that's only going to help increase sales of their already strong. They have a cancer drug, Ibrance, as well as an anticoagulant drug, Eliquis. Both of those are in the top 5 currently drugs with the fastest growing sales this year. So you combine that with what they have coming down the line, and the prospects are quite positive, and it's good to see the market responding positively to a positive earnings report.
Yeah, and the other thing here that's interesting is pharmas have not yet broken out above that January high, yet you have a leader with Pfizer, as you can see, breaking
Mm-hmm.
out. So on a relative basis, you got a stock that's performing really well relative to its peers and has now strengthened and taken out a double top relative to the S&P 500. So things definitely looking up at Pfizer. I'm not going to take any more of your time, though. I know everybody's waiting patiently for your workshop and how you market, so I'm going to let you take it away.
Okay, super. So I will go ahead and begin by reviewing some of the items that I have been doing for many years. So for those of you not familiar, I have been in the markets for quite a few years, and a good part of that was either on or with Wall Street. As it relates to stocks and uncovering and now developing a system, a good part of my time with equities was with William O'Neill and Company, and many of you may know him as the founder of Investors Business Daily. And I'm pointing that out because my current system is built upon my many years there, which I have then since developed and refined so that I can work more closely with self-directed investors. My work with O'Neill was with primarily professional money managers, and I was at that time really educating them on this system. And it's a system that is built on many, many years of studying prior market winners, looking at those big multi-year stocks up between 100% and 1,000%. And it was uncovered, and studies are still ongoing. It was uncovered that these stocks do have characteristics that are common among them before they break out and have these runs and extensive gains. So that really is the focus of my work. And as such, I've developed a system over the years to really help refine and funnel. The markets have over probably about 7,500 stocks that
Hey,
would.
Mary Ellen,
Mhm.
I'm not sure if your screen is showing. I think my screen may still be up.
Okay, that's good insight. Let me go ahead. I really wasn't showing anything of import, but I do want to certainly share my screen. Thank you.
Oh, I'm sorry. I just wanted to make sure you were.
I appreciate that. We should be better now.
Yes, thank you.
Super. Thanks, Tom. Okay, so really just uncovering and giving a bit of background as far as what work I do and what types of stocks when I am drilling down, I am looking for those stocks that are poised to outperform the broader markets. And so as such, there is a system that I have in place that you can very easily adopt. And again, it is based on those principles that were founded. It's a solid, proven system of looking for these key common characteristics among these stocks before they take off. So let's go ahead. So I will go ahead and review those characteristics common among stocks that are poised to go higher. And then I'll go ahead and review where you can easily screen for them. A lot of times people have trading platforms, but I will tell you stockcharts.com is more than enough as far as helping getting you in front of these stocks. I mentioned here how long you should stay with the stock, and this is something I mention a lot. It has to do with entirely with your investment outlook. So if you are a shorter term trader, of course, you will trade in and out of these stocks because the stocks, they are momentum stocks. They do move faster. So they will allow you that opportunity to get in and out. But for those of you that are longer term, certainly you would use a longer term price chart to help you stay with that stock. And we'll go in and take a look at some examples. And I mentioned using the broader market to give you confidence, and that really is one of the primary foundations, really, for any kind of investment system or style. And that is, you absolutely want to make sure that the broader markets are healthy. Are they in an uptrend? Is the wind behind your back, so to speak? So we will go ahead and let's get started with that. And we can take a look at a couple of the broader market indices, and then from there we can drill down. So what we're looking at here is a daily price chart of the NASDAQ. And the NASDAQ had been leading the broader markets, certainly subsequent to this correction. It was the first index to hit a new high in price, very bullish. Had a little bit of a downdraft here. Some of the tech stocks got caught in the trade war with China. But now, more recently, last week, it did hit another new high. So we were looking very good going into earnings. But of course, we had that Facebook bomb, if you will, and followed by Twitter and others. So here we are with this daily price chart, and we can see that the NASDAQ has had a couple of tough days. It was down, if I can get my cursor over here. We can see this sell-off here. This is last Friday. This is as of the close yesterday. And we are just a bit below that 50-day moving average. And I'm pointing that out because a break below the 50-day moving average certainly would be concerning. This is a moving average that is very widely followed, widely on Wall Street, so that it is something that is paid attention to. So we will want to take a close look, see if it can maintain, at least get back up above that 50-day. But let's go down here further. For these broader indexes, I like to use the stochastics, and it is a faster moving momentum indicator. And what we want to do here is use the stochastics. The dashed line is your net neutral. And if you go up above this line is 80, it indicates the index is overbought. And it's with an anticipation at some juncture that it will come back into perhaps the mean. If we break below this dashed line, that is a negative. And down below the 20 is oversold. So let's take a quick look at the position where we are currently. And you can see that the NASDAQ did break down below that net neutral, which is 50. So it is in a negative territory. We have broken below this 50-day simple moving average. So we are in a bit of a precarious position, if you will. And I'll take you back to other periods where we've had these breaks, and you can see the subsequent breakdown after it's broken below. Now, that said, we do have other more positive characteristics taking place. That is your longer term trend. That's your 200-day simple moving average is still very much in an uptrend. And really looking at this, it's critical to note what you want to look for the reversal of this current downtrend that's taking place. You want to see these stochastics come down, reverse, and once it breaks back above this dashed 50 line, it will align you with this type of action where it is now broken back above key moving averages. Your RSI is back in an uptrend. So that's what we are on the lookout for as far as this index coming back into favor, returning to health, so to speak. And here's a quick peek at the S&P 500, and you can see that its near-term uptrend is uninterrupted. This is a 10-day simple moving average. The index is remaining above that in a very clear-cut uptrend. So the S&P has been able to withstand the broader market pressure, certainly the selling pressure within technology. And Tom very astutely pointing out the what we are seeing in the way of rotation. It's into these industrials. It's also financials. I know they're wavering a bit today, but they have been recently quite strong. And then we also have other pockets, and we talked about big pharma within healthcare. That's going to be helping the larger cap S&P 500, and certainly within defense-related stocks. So let's go ahead and take a look. There was one item that I did want to mention to you. It is a statistic, and it talks about the importance of a stock's industry group relative to its potential outperformance. And this is going to be something that many of you may not be aware of, but it is very, very well worth noting. And that is, I talked about the studies that went into looking at characteristics among stocks poised to trade higher. One of the findings within the study was that when you look at the stock's price movement, 37% of that price movement is directly related to the performance of the industry group that it's a part of. Now, that's pretty profound. Almost 40% of the performance can be attributed to the group that that particular stock is a part of. Now, there's more. There's another 12% of the stock's price movement is due to the strength of the overall sector that that stock is a part of. So when you think about it, there's roughly half of a stock's move is going to be driven by the respective group that it's a part of. So I did want to start there because as a way to uncover these potential stocks, most certainly you will want to begin by looking at where the strength is in the market. And when I say strength, I mean which industry groups. We can start with sectors and then drill down which sectors are outperforming the broader markets. Where are the money flows going into? And because these sectors are outperforming, it implies the underlying stocks within those sectors are driving that sector to outperform. So what we're looking at here is a candle glance chart of 12 different indexes. And this is very, very easily accessible on stockcharts.com on their dashboard page. So quite simply, what I've done here is outlined some of the larger components of the S&P with their sectors, consumer staples, healthcare, and so forth. We will review them. And then also put in there some ETFs, and that is another very helpful way for you to stay on top of where the strength is. And I'll show you where you can quickly access some of these ETFs that are going to point you in front of where the outperformance is. So quite simply, these 12 charts are overlaid with an RSI, which is a relative strength indicator, and it's sorted by strength. So we're looking at a 2-month daily price chart of these various sectors. So by sorting that, we can see quite clearly from the upper left as we trend to the right where the current strength is in the markets. So we can see that consumer staples is showing up here in the forefront. And this is a sector for those of you, if you just put this in your tool belt, whether you do it daily or weekly, it's going to be equally impactful because you're going to be able to spot this type of rotation. For instance, about 3 to 4 weeks ago, the staples were languishing. They were down in this lower right-hand quartile, which is the weakest area. And it's been over the last 4 weeks that we've watched a steady progression of these staples to the forefront. And that kind of rotation and that progression would have gotten you in front of some of these faster moving, I believe. We can get into stocks as we move on. And then the next group in health right now is healthcare. And we talked about some of those large pharma, Pfizer's one, Eli Lilly, and they are helping to push healthcare into the second standing here. And then here are the industrials. And Tom spent quite a bit of time talking about these industrials and how they are showing quite a bit of relative outperformance and strength. And it has everything to do with those transportation, those rail stocks. Defense is a big component here. And then we're even seeing, as you drill down into these industrial, they produce industrial, whether it's tools, products, those kind of things. But industrials are really seeing quite a bit of strength, and it really is warranted. A lot of the work that I do is centered around looking for growth by way of earnings. And so we are seeing a lot of these industrials come in with very strong earnings. So it is warranted. That's important as well. So then we drill down. Energy is the next, followed by consumer cyclicals. So let's go ahead and take a look at some of the characteristics of a stock that is poised to go higher. Now we have a backdrop. We know that the broader markets, certainly the S&P, is in an uptrend. We now have a handle on where the strength is sector-wise. Let's take a look at some of the characteristics of stocks that are poised to go higher, because as you drill down into those various sectors or industry groups, you're going to want to know other characteristics of particular that drills down to individual stocks. So the first item I have is the stock is at or close to hitting a new high in price. And that is a very relevant characteristic, because a stock that is hitting a new high, of course, is under accumulation. There are buyers, and it is a clear-cut sign that the stock is showing strength. It doesn't have to be at an absolute new high, but certainly close to it would hit the radar. Now, there is one caveat in today's market, and that is because these industrials, these financials, those stocks that are now coming into their own, they are not oftentimes going to be hitting a new high in price because they had been so depressed recently and they had been underperforming. And that does not mean that you cannot still search there, because you also want to pay attention to relative strength relative to the rest of the market. So this new high in price is a characteristic that would be ideal, but I will tell you, in the current market environment, it's not an absolute. And then also you want the stock to be moving on volume. And by that, I mean moving higher. This volume is going to tell you that institutions are in there supporting that stock. And these institutions, their money accounts for 80% of the daily volume in any given stock. So you do want the institutions in there. They are the real footprint, if you will, on a chart, and they are going to help drive a stock higher. So you do want the stock coming up to that new high on volume. And then really critically important as well is the position of the price of the stock versus its key, I left this out, but its key moving average. From my work, you want the stock to be above its simple moving average, ideally, certainly at least the 50-day, and you want that moving average to be in an uptrend. So let's go ahead. I'm going to escape out of here and take a few minutes. I talked about how you can then drill down. You now have the backdrop, the foundation, as far as what you need to look for in the way of the markets and industry groupings. So here I'm at stockcharts.com with their predefined scan results. And this is a daily, updated throughout the day listing of stocks using different scans. So I talked to you about stocks that are hitting a new high in price as being a wonderful place to begin your journey, if you will, to begin your search. And you can see that there are 183 stocks today that are hitting a new high in price. So let's just, for sake of ease, go to the NASDAQ. It has a little under 30. What I'm going to do here is quite simply click on to that, and it's going to provide me with a list of those 30 stocks that are currently hitting a new high in price. And ideally, what you can do from here, you can then sort this list so that it can benefit you the most. One of the easier ways is to sort it by market cap, if you are inclined to trade in larger stocks, or you can sort it by the scooter indicator. And this, for those of you that are not familiar, this is a indicator that was developed by John Murphy, and it's really quite incredible. It's a longer term look at a stock. It takes into account money flows, but it's not just current and recent. There are a number of other underlying factors that are taken into account. But let's just take a look at one of the stocks that shows up here using that scooter. The higher the number, the better, to give you an example of the type of strength that you can be put in front of. So right now, this is Illumina, and this is a stock that came out with earnings today that were absolutely superb. I do put out a biweekly newsletter. This is one of the stocks that was highlighted on our list as a buy opportunity. It did fall in line with the broader markets. It's up almost 10% today, but you can see longer term, the general trend has been up. it's been a very good stock in the broader markets. But now that we're looking at the stock, I talked about the need for the stock to be above its simple moving average. It's approaching a new high. So this would be a candidate if you were not already in the stock. Now, a lot of people, let's just do a weekly, may be put off by the fact that the stock has already had an extensive move. But realistically, this stock is going back. We're at about the 18-month mark for the outperformance of this stock. And winning stocks, big winning stocks, can go on for multi-year moves. It's not only for a brief period, but it is certainly for at least 18 months. That is the average advance for these big winning stocks. So let's go ahead back to that list and we can take a look at, this is another stock that happens to be on the suggested holdings list for my newsletter. It's Appfino. And this is really wonderful to see because this is a software stock. They work with real estate companies, and you can see that they are up 17%, also on super strong earnings. And this is a stock that's a little bit earlier in its advance. It did break out. We picked it up here in April, and it is breaking out of yet another base. So a lot of the work that I do is also looking for chart formations such as saucer-like bases, stocks breaking out of those saucer-like bases, as well as flat bases. That's another example. So that is one way that you can get your arms around potential candidates by looking at stocks that are hitting a new high. This is another stock that's on our list, suggested holdings list. And this one is also breaking out nicely. This is Echo Global Logistics, and this is a play on that move to transportation stocks. And these stocks need to have logistical companies that can help maneuver their, whether it's shipping, trucking. This company is moving into shipping out of and expanding beyond trucking. But you can see that the stock is breaking out now of a very long base, making it actually an very, very attractive stock. So let's go ahead back. I did want to point out to you other ways that you can potentially get in front of these stocks that are poised to outperform the broader market. So we talked about stocks that are hitting a new high in price. We can also, simply because of where we are in the broader markets, as far as those industrials, some of those stocks that are not necessarily hitting a new high, your strong volume gainers. And this is a screen that for purposes here is being run on a daily. And again, I'm going to just scoot over here to the NASDAQ and take a peek at those stocks that are hitting, that are up on volume today. But for those of you that have a longer term outlook in your investing, this is a type of screen that you can run on a weekly. A lot of the professional money managers will have this, where they're looking for weekly volume greater than prior weeks. They don't want to see this every day. But taking a look at the strong volume gainers today, one other way that you can sort this is by industry. So this is going to tell you quite simply that healthcare today, whether it's pharmaceutical, medical equipment, or biotechnology, we can see that today's action relative to those that are trading on above average volume is concentrated in healthcare. And that can help formulate your opinion and help the backdrop for you as far as helping you uncover where the given strength is in the broader markets. I just want to make sure I don't go over on time here. But the other item that I wanted to mention to you is taking a look at sector strength. We talked about using that candle glance, and what I wanted to do was go ahead back to that. And what we can do from here, this is that same candle glance sorted with the sectors by strength. What we can do here is simply go ahead and access a chart of that particular industry grouping. And I'm pointing out consumer staples simply because this is a sector that really underperformed, certainly since the peak of that correction we've experienced earlier in the year. But you can see that the sector had started to reverse. This is that progression into strength that I talked about that started in June. But I wanted to point out to you that this week and at the end of last week, the index broke above its 10 and 200-day simple moving average, which is now pulling all of these moving averages up. So it is now entering a very constructive period, if you will, within the consumer staples, because the index has turned positive. So what we can do from here is go ahead to that interface, the initial interface with the dashboard. And I'm going to take you to one other area that can be really helpful for you as far as drilling down. This quite simply is a daily view of sector. We can see the industrials are up 2% today, followed by healthcare and materials. But what I like to do is take a look at the 1 week performance, particularly at the end of the week. And this is going to take you from Tuesday to Tuesday. And you can see the industrials are very clearly in the forefront with a 3.47% move. So quite simply, what you can do from here is click onto the name of that industry group. And this is where it gets really interesting for me, and it should for you as well, because in addition to knowing where the sector strength is, you really are going to want to know those subgroupings, because oftentimes a group will bubble, a sector will bubble up to the top, but not all areas underneath are participating. And then certainly these subgrouping and the ability to drill down beyond the sector is going to be really powerful as a way to get you in front of these stocks. So Tom talked about waste and disposal services. He reviewed a couple of stocks there. What we can do from here as a way to get down into those individual stocks is click on to the name of that subgrouping. And here we have a listing. This is based on the 1 week performance, Tuesday to Tuesday. You can see where the relative outperformance is. And then another way to sort this would be to that sector, the scooter, pardon me. And then from here, you can go ahead and drill and look at the individual stock. And this is US Ecology. And this particular stock looks very attractive from my work because you can see it is close to hitting a new high in price. It is poised to break out of a 1 month base. And all of that is quite constructive. The RSI is poised to, it is positive, it's trending positively, and your MACD is poised for a positive crossover. So you can see the power, the ability, once you know where the strength is, you have a sound reasoning for why there is movement into that group and whether it will be sustainable. From there, you can then, of course, drill down into these individual stocks. This is another stock. This is Waste Management, and they reported earnings last week. And this particular company, they have been, you can see, underperforming for quite some time. This stock really had a big pop last week. It was up 9% on this, 8% on this earnings. And the company cited in advances in technological waste removal as one of the reasons that their earnings were so strong. The other reason was tax related, and that is something that will continue to benefit them, of course, through the year. But you can see where the stock had this huge gap up, came close to breaking out. But the beauty here is that it is continuing to advance. So we can see this big volume day on that earnings release date. Is the institutions coming in. But the fact that the stock is still finding buyers and finding support is really quite constructive. It is a bit extended. From my work, I would wait for a pullback, but let's go ahead and take a look at some of the other stocks. Just one last one. This is Casella, CWST, and this is another one that is poised to break out of a multi-month base. And actually, you can go back even longer and make the case for a 6-month base, but it looks quite positive, very constructive. But we can move to other industry groupings. So we can take a look at some other, the rail stocks are all here for those of you. I would urge you to do this practice where you go into the sector, sort it by 1 week, and then drill down. It's really going to point you to these stocks that are not only outperforming currently, but have constructive looking charts that have them appearing poised to continue to outperform. Now, I mentioned consumer staples because that is a sector. It didn't move positively in a real powerful fashion, but it's certainly enough to get the interest going. So again, this is on that 1 week. And what we can do is drill down into some of these other sub groupings that one may find interesting. And this is where you're going to start to see names that you may not have hit your screens for many years. A Clorox, Kimberly-Clark. And I'll tell you, I'm going to drill down and look at Kimberly-Clark. They just came out with numbers. They're reversing a huge downtrend. And these companies really are expanding into other areas outside of their core grouping. You might think of Kimberly-Clark for diapers, but they are expanding. They are creating new products that are expanding to an evolving consumer as it relates to certainly within the food industry. You can see that where they are creating exotic sauces, and there are other examples similar to that. So hopefully you have been able to get a feel for one of the easier ways. I did want to go outside, one of the easier ways to find where the strength is in the broader markets, and then armed with that knowledge, drill down to individual stocks that are poised to outperform. I did want to point out quickly one other outside source that you might find easy simply because of its simplicity. What I'm pointing you out here is it's called ETF.com, and they've done quite a bit here. It's just a really simple snapshot. I found it very informative on a daily basis. They are taking real-time performance. So they have the 9 sectors listed on top, and then down below, they are providing you not only with the S&P symbol for that given sector, XLF is financial, and so forth. Then they broaden it out even further. So for instance, Tom was mentioning that financials were a bit weak today. You can quite simply drill down and see that it's KBWB, that is your regional banks, and then also your banking services. This is going to be probably your credit processors, your PayPals of the world. But let's take a look at the darker green ones, and we can see within the consumer cyclical, the home builders are up 1.5% today. And then moving over to the industrials, defense related is the strongest. It's up 2%, and so forth. So I think you can get a feel for it, but they also do a lot in the way of value style. I've been paying attention to this closely because it has been growth all the way for quite a bit of time, and it's only been through the last week that I'm starting to see a pickup here on the value side. So that's something to pay attention to as well. So let me go back to my primary presentation, and we can take a look at some conclusions based on what we have covered today. There, of course, is so much more that I could cover. But I think we've uncovered quite a bit today. We talked about those characteristics. The stock is at or close to a new high in price. You want to see that volume as a stock breaks out of a base, as it hits a new high. And then also the position of the price versus its key simple moving averages. And so let's take a quick peek at how you can screen. We talked about drilling down from the broader markets down to sector, down to sub-industry groupings, always with an eye toward strength. You want to see where those money flows are trending. with an eye toward a continuation of that money flow. And so the first item that you can screen for is looking for stocks that are up on volume or hitting a new one-year high in price. And that is something that we did on stockcharts.com. They have those pre-defined screens that in a beautiful way do that for you. But this screen is always with that backdrop. You have that knowledge of those groups that you want to pay attention to and be a part of because you've done the work to where the strength is industry group wise. And then also you want to use technical indicators to confirm the candidacy. So oftentimes these high up on volume, and oftentimes if they're hitting a new high in price, they will certainly be above those key simple 10 and 50-day simple moving averages. That is not normally where you need to be as concerned. But if you are screening for stocks that are up on volume, you do want to overlay a screen so that within that they are also above their upward trending 10 and 50-day simple moving average. That's going to save you a lot of time as far as going through a lot of stocks that really are not going to be viable candidates. Now, stop losses, I often talk about the need to have a stop loss in place when you are trafficking in and trading momentum stocks. These stocks are going to be faster moving on the upside, and certainly that's something that you can enjoy. However, historically, these stocks, once the uptrend is over or it begins to come under distribution, they are 1.5 to 2 times on average, they will go down faster. So that's pretty significant. We've seen that, for instance, with these software stocks. Certainly Facebook down 20% is an extreme example, but I will tell you last Friday, subsectors under the software industry grouping were down 4% versus the relative broader NASDAQ was down 1.4%. So it's critical if you are in these stocks that you have a system in place so that you make sure that you cut your losses and preserve your profits. And then here I'm mentioning using weekly metrics for longer term traders, and that has everything to do with these screenings. There's not an absolute necessity to run these types of screens on a daily basis. It can be a weekend activity, and it will have that same impact as far as getting you in front of those groups and in front of those names. And there's one other component that I did not mention today for screening purposes, but for those of you that do have the capability to screen for fundamentals, you will want to see stocks and own stocks that not only have earnings in place, but they have prospects going forward for strong earnings. As many of you who have watched my MEM Ed show, you'll know that from the many years, my many years of work, the primary driver of a stock's price upward is going to be earnings. This is what these Wall Street firms, their fund managers, they need to see that growth. And it can be earnings, it can be profit margin. It's all going to depend on the industry group that stock is a part of as far as the metrics that are used. But bottom line, there is a need for not only current growth, but for expected growth going forward. And I'm thinking that timing wise, I might be at the end here, but I could.
I was just going to say it was a great presentation.
Okay, super.
Very, very thorough. I'm sure everybody enjoyed that. And I actually was looking at your CWST that you talked about. That was in the waste area that I had talked about earlier today. And that was a really nice base that you had shown there. So
they're due to report Thursday.
Yeah, that's against my investing or trading.
Yes, I hear you.
I don't like holding into earnings because you might see at the back, at the bottom end of the range after its earnings. You just never know. But it is a really nice looking chart. I just wanted to point that out. But great presentation, Mary Ellen. Really enjoyed it.
Super.
Okay, let's go ahead and jump into the 10 in 10. We do have, like I mentioned earlier in the show, I have already picked the 10 stocks. These are scooter movers, some pretty big scooter movers, and I'm going to go through them pretty quickly. I've already annotated them. So let's just jump right in here. First up is Seagate Technology. You can see STX, after reaching a high back in mid-April, has been going sideways and consolidating. It gapped down and established what I think is a pretty important low at about 51, 51.50 in early May. We bounced off of that, filled the gap, actually went a little bit higher, never quite reached the high in mid-April, and now rolling back over. But this is a key trading range that I would watch on Seagate, 51.5 up to about $62. The second stock up is Xylem, XYL. Beautiful uptrend that it was in play for about 14 months. And then at the top, we had a triple top. We came back down. We lost that area of support, lost the 50-day, got a death cross, the 20 below the 50. And that set up weakness for the next few months. And I believe we had a bullish wedge off of this uptrend that recently just broke to the upside. Got good news. I'm not sure if this is an earnings related move today or not, but
It is, yes. Pardon me. And this is a machine tool company, and it's in line with that move into these industrial stocks.
Perfect. Stock up 9% today, and it looks to me like it's heading up to test that triple top that we saw back in March and April. So $80, $79 to $80. I would suggest, at least for me, I would be taking the money and then waiting for a pullback. Next up, we've got Wynn Resorts in the gambling space. The stock's doing pretty well, but I'm a little suspicious. I was looking at this. Stock made a huge move to open the year, had a massive sell-off. Look at the volume coming in January and set a very important bottom. We had a hammer a month later, maybe 5 weeks later, that also tested that bottom. We bounced, went all the way to the top of the range, and then came back down. I'm not sure if that's would be considered a spring potentially in Wyckoff, and maybe we're just going to go higher. But if we go back down below that 160 level, I would think that'd be a pretty big warning at this point. So I'd be looking maybe for gap resistance to be cleared around 168. And I didn't highlight it, but it would be nice to see some volume coming in on this move to the upside. Otherwise, I'd be a little upset that we've got the volume on the downside and no volume returning back.
And sometimes with these stocks, it's helpful to look at other stocks within the given group. And I will tell you that these casino operators in general have been underperforming and do not look healthy. And I think a lot of it has to do with their Macau presence. They're suffering a bit. But overall, it is helpful to sometimes take a look at LVS and some of the other names, and they're equally languishing. So,
no doubt. This has been a very weak group over the last couple of months. Cognex, CX, or CGNX. I actually want to just take a second to point out a few different gaps. They look like they're earnings related gaps, and these are the kinds of gaps that I like to trade. But off of the start of a downtrend here back in early December, didn't quite get back up to the high. And you can see this is a continuation gap where we actually gap back down in the direction of the prior trend. We moved all the way down, the heaviest volume on the chart. This was an exhaustion gap down, very strong hollow candle after the gap down. That actually seems to have marked the bottom now, especially with this breakaway gap. A breakaway gap is just different in the sense that we've been moving down for several months, and now all of a sudden we have a character change on the chart. Very heavy volume, gap up. We've been trading up almost all day. Strong looking chart here off of the breakaway gap.
And I don't know if we have time. I was just going to mention they have two components to their revenue source. And one is they do factory automation for consumer food and product. They've seen tremendous growth there. And they also do the OLED for smartphones. So they have two pivotal growth areas that are seeing expanded increase in demand.
Awesome. All right, we'll keep going. Let's see, Service Corp, SCI. A little channel we've been downtrending in for quite some time. Today's volume, though, strong. Probably, I think it actually was earnings related. I remember seeing this one earlier today.
It was.
Yep, the recent high back in February, around 39.5 or so, maybe just above. Tested earlier today. We're backing off. But if we can close above this trend line here, I think we're breaking the channel, potentially moving back to the upside.
And that stock is a funeral service provider, and it caught my eye, and I thought, now what the heck, why are they suddenly having great earnings or more people passing? But it is tax related. They were benefited from the tax cut, and then also their revenues from their cemetery has increased.
Whoa.
Thought that was worth noting.
Yeah, I don't know exactly what that means. Well, I know what it means, but we won't go into that. Let's see. Auto Home, ATHM. We did have a move to the upside. The only thing I wanted to highlight here on this one is that if you look at the group itself, computer services, you can see that they're specialized. Actually, what is the CS? Specialized consumer finance? Anyway, the group itself is doing much better to the upside. But Auto Home here on at least for the last 5 to 6 weeks has been declining on a relative basis to its peers. And so I would be watching this price support level very closely. I think we could get a solid reversal off of this level because the group itself is strong. But if we break down with a group that's breaking out, that would worry me. Logitech, LOGI, negative divergence. We got higher prices, lower PPI. I look for a 50-day test and a PPO centerline test when I get these negative divergences, especially when we get a reversing candle on increasing volume at the top. So I'm not shocked by the recent weakness here in Logitech. This could be the end of it with this long tail to the downside, but I would keep an eye on about 42.75 in terms of price support. Aerojet Rocketdyne, one of the best stocks in the market today, up 17%, breaking out above recent highs in 2018. And it's really hard to ignore this volume move to the upside. 4 million shares already have traded today. Still 3 hours to go before the close. So if we can get this breakout confirmed on the close, I think this is one on a pullback down the road you might want to consider. Small bio tech stock, BioTime, BTX. The only thing I would caution you about is going back over the last few months. I mean, sometimes you trade less than 500,000 shares, and we're only talking about a $2 stock. So the dollar volume here is not very significant, can be easily manipulated. So you want to be careful with that. But technically, I do like these tests of the 20-day moving average. They're highlighted with these green arrows. Trying to make another breakout today, and you can see volume very strong. So if we can make this breakout, I think we got a chance to make it up to that 285 level. And we could see a little bit more resistance at that time. And then the last one I have is Trex, TREX. Big breakout here. I also wanted to mention this one because Trex, relative to its group, is doing well. Relative to the S&P is doing well. But its group is performing horribly relative to the S&P 500. So in finishing up on this one, I have a kind of maybe a strategic or a strategy question for you, Mary Ellen.
Mm-hmm.
When you see a stock like this that's breaking out and is kind of doing something that the rest of its peers are not doing, outperforming the S&P 500, how do you treat a stock like this? Would you be interested in getting a stock that's breaking out, doing very well, but it's in a group? I mean, you mentioned earlier that the industry and the sector are 50% of a stock's performance. Well, this one's up despite that. What do you say?
That is a fantastic question. Yes, you are better served, and this is all through studies, you're better served to be in a weak stock in a strong group rather than be in a strong stock in a weak group. And that's a quote directly from Bill O'Neill. I've been in presentations with him. And even though this looks attractive, I saw that. I actually dug in and I found out that construction spending for their wood products has been on the move. But overall, you would like to see other components within that given group supporting that move, unless it's a super tiny group. I'm not quite sure how many. I think how many stocks are in there, but.
Yeah, I would just add too, when you've got a breakout like this, you got a weak group where money's been rotating kind of away from this group. You would think that at a minimum, you're going to get a pullback here, maybe back down to that 70 area where we kind of broke out from. So I certainly wouldn't chase a strong stock in a weak group.
Super, you're right.
Okay, here we go with the summary on the 10 and 10. Take a quicker look at 10 stocks. Again, what I did is I looked at some of the scooter movers. So that's why we had some big moves in both directions. Thought we'd take a quick look at some of those stocks and see how they looked on their charts. And of course, thank you, Mary Ellen, for some of the added fundamental information that you added on many of those stocks as well. Sure. We're going to be back here in just another minute or so. Just take a second for this break, and we'll be back with that final market update.
Volatility is back and interest rates are rising. With the markets headed into uncharted waters, ChartCon 2018 is here just in time. See how the experts are protecting themselves and watch live from the comfort of your home or office as they reveal the risk management strategies they use to stay profitable in any market. Plus, you'll get complete video recordings to watch on demand for years to come. Join us at ChartCon 2018, streaming live August 10th and 11th.
Hey, welcome back. Let's take a look at the market real quick. We got the Dow Jones Industrial Average still up near the high of the day, up 179 points. We got the S&P 500 up nearly 20. NASDAQ up 61, trying to get back some of those losses from the last couple of days. Russell 2000, a little off its high from earlier, but still up nearly 20 points today on a relative basis, leading the other indices. 10-year Treasury yield continues just to meander a bit lower today, sitting down about 2.96%. Volatility on the move lower after rising the past 2 days. Industrials continuing to strengthen here, getting up close to that 77 level, looking like it wants to make the breakout. But let's see how it holds up into the close. Financials, which it pulled back earlier, are off the lows of the day, trying to rally back. 28 to 28 and a quarter has been a key area of resistance on the XLF. So let's watch that, see if we can finish strong into the close. If we do, finishing on the high of the day on the XLF, that would be bullish. KLA 10 Core, Illumina, Charter, all reported earnings today. Of the three, Charter is the one that gives me maybe a little bit of heartache here because we did have the breakout earlier today, but we have pulled back down below that 310 level. That candle suggests to me if we finish like this today that we may go back and fill that gap down to around 295. So I'd be a little careful with that one unless we strengthen into the close. And Qualcomm, as mentioned earlier, did have an announcement out about some of its buyback, and the stock up almost 4% today on the news with some increasing volume as well. Okay, we have our final segment of the day, and that is going to be the seasonality for August. So I am going to pull up the seasonality for you, but first let's just go back to the home page. And what I want to do while you can just kind of look at the market, I just want to read to you a couple things about August before we actually start pulling up some of the seasonality charts. The first thing you need to know about August is it's not a very good month. When we take a look at it, from an S&P 500 standpoint, since 1950, August has risen 37 times. It's fallen 30 times. Annualized return during the month of August on the S&P over the last 68 years, minus 1.05%. That ranks it 11th out of the 12 calendar months, beating only September. The NASDAQ also ranks 11th out of the 12 months in August. NASDAQ since 1971 has risen 26 times. It's fallen 21 times. Annualized return, a meager 0.28%. The Russell 2000 since 1987, it's gone up 16 times. It's fallen 14 times. It is got an annualized return in the month of August of minus 7.5%. And that ranks dead last among all the calendar months. So you can see across the board, August just typically isn't a very good month for the market. I always look to try to break down the month and tell you which areas of the month are bullish, which ones are bearish, and so at least have some tendencies throughout the month. But what I find with August is that it's just boring. You get a couple days where it seems to be kind of strong, and then you have a couple days weak, and there really just aren't any trends of any magnitude in either direction. So what I did is I broke down the S&P 500's August performance between the 1st through the 15th and the 16th or the 31st. The 1st through the 15th, the annualized return is minus 1.90%, and the 16th through the 31st, minus 0.32%. I mean, there literally just is nothing going on in August. Enjoy your vacation, have fun, because the stock market is typically not a great place to have a whole lot of excitement during the month of August, unfortunately. Maybe, different years are different. Sometimes we have strong August. Sometimes we have weak August. I'm just giving you the overall tendency, and that is that August is just not a very exciting month. Areas of the market that lead. I'm going to show you one place that you can find an old blog article of mine if you want to know which sectors tend to perform or outperform at various times. If you go into my blog and you click on the blog archives here, in 2017, back in January, I wrote an article. I think it was on January 7th. Here it is. Summary of sectors, relative strength by calendar month. And so what I have here, going down the left side, you'll see the different sectors. Going across the top, I've got the calendar months. And what these numbers are for the XLK as an example, you'll see January 1.2. What that means is that during the month of January, we actually have outperformance in technology above the S&P 500 by 1.2%. This doesn't mean the XLK goes up an average of 1.2%. It means it outperforms the S&P 500 by 1.2%. Any of the months where you see relative outperformance by more than 1%, you're going to see this dark green shading. If you just have outperformance, but it's less than 1%, that's where you see the light green shading. And then when you have anything that's negative, anything less than 0 is where you see the red shading. So we could look ahead, for instance. Now, again, this needs to be updated because this was back a year and a half ago that I wrote this article. But in August, you can see that it's a boring month. There's just not a lot going on. The three groups that tend to be a little weaker than normal, healthcare, materials, and consumer discretionary, are just barely weaker than the S&P 500. And there's no groups really that have a lot of strength. We do see consumer staples show some strength in August. We see energy show some strength in August, relative strength. And perhaps it's noteworthy that August and September, you can see some relative strength in the defensive groups because August and September tend to be weak in the stock market. And as a result, money does rotate during weak periods into defensive areas. So I think it's noteworthy that you see some of the weakness in the market that we typically see in August and September result in relative strength in these groups. Again, it doesn't necessarily mean that these groups are tearing to the upside. It just means that they don't tend to move lower to the same extent that perhaps the benchmark S&P 500 does. So those are some areas to look at. So within this group, and the way you can do this at stock charts, by the way, let's take a look, for instance, at consumer staples and the seasonality so you can see how you do this. The XLP is your sector ETF for consumer staples. And if I put in there the seasonality, this will show me how the XLP does over the last 5 years, and I can drag it back to the last 20. And this is just giving you average returns of the XLP. Now, if I want to look at relative performance, I can simply type in here the XLP relative to whoever I want to look at, XLP versus the S&P 500. The default 5 years, I drag it back 20, and here you see August and September. Here is that relative strength that I talked about in the consumer staple space. And it happens to be, if we get rid of the S&P 500 here and take a look over and just pull up the S&P 500, you're going to see that over the last 20 years, August and September tend to be very weak months. And so as a result, with the S&P not doing so well, the consumer staples and other defensive groups tend to outperform on a relative basis. Again, doesn't mean we go shooting to the moon in these groups, but they tend to outperform. And when we take a look at something like the XLP, a sharp chart, and I know Mary Ellen alluded to this earlier, this is the stock, or this is the sector ETF that's been doing pretty well, moving from left to right. You can see it's been rising over the past few months. So this is a group that already is showing some pretty strong technicals. And we do know that going into the next month or two, this is a group that tends to outperform. So it certainly makes sense to me that you might want to have some exposure in consumer staples. Groups that don't do so well, we talked about materials, healthcare, and the consumer discretionary. So those are, some names. I know if we look at some industry groups within the consumer discretionary, I can tell you that autos do not do well. Let's go back to the seasonality. Let's take a look at the autos. Autos have been under pressure technically. We talked about that yesterday. We've been talking about it quite a bit. But if you go back the last 19 years, look at the results on autos. August, there's an average 2.9% decline during the month of August. September, average 2.1% decline during the month of September. So 5% autos average going down during the month of August and September. It's a group that, based on the current technical picture, based on the current seasonal picture, autos might be an area you may want to avoid. Another group, steel. Let's pull up the steel group. They've been in the news quite a bit with all the tariffs and everything. But August has not been kind to steel. And if we drag this back over the last 19 years, steel has gone up only 22% of the Augusts going back the last 19 years. And the average return in August, minus 3.1%. The average return in September minus 4.9%. Steel averages going down 8% between these months, August and September, going back the last 19 years. Another group based on seasonality that I'd probably want to avoid, notwithstanding what their charts might look like. As far as some of the groups that do well in August, let's pull up, and I don't talk a whole lot about the miners, but let's take a look at the DJUS PM, which is the gold mining index. Seasonality. Now, keep in mind, too, that August and September, because the market tends to move lower, a lot of times money looks for defensive areas, and the miners fit that mode. So what I would be saying here is that, yes, August is an area or is a time of the year when the miners, you might want to take a look at some possible trades. It's gone up 78% of the time in the month of August, and the average gain in August, 5.1%, going back the last 19 years. And if you look across at all the other months, the second best month is 2.1% versus 5.1% in August. So this is definitely a month to consider the miners. Also, a group that I would consider, tobacco. We just talked about the consumer staples. Tobacco is a part of that group, and tobacco averages 2.4% during the month of August, which is one of its better months of the year as you look across. And if I pull up the chart on the tobacco stocks, they were very weak back here. I think this may have been Philip Morris earnings report or maybe a warning. I can't recall. But anyway, we're starting to strengthen in the group. PPO looks good. We're starting to use that rising 20-day moving average as support. And knowing that this group tends to do well in August, maybe this is an area that you consider, obviously keeping your stops in play. Individual stocks. Let's take a look at a few of these. Well, there's a bunch of them that I could go over, and I will go over, but let's take a look at one in particular here, SWKS. These are all NASDAQ 100 stocks. We've seen the NASDAQ 100 under a ton of pressure recently. So as we look ahead in August, what stocks might lead the NASDAQ 100 back? Well, Skyworks Solutions is one. SWKS. Last 20 years, goes up in August 68% of the time, and it's averaged gaining 7.4% during the month of August over the last 20 years. That's pretty good annual return in some books. And SWKS has been doing pretty well. Now, the chart itself doesn't look particularly strong at this point, but if we see a positive divergence, maybe at some point in August develop, or maybe we strengthen, move back above the 20-day moving average, those could be signals to perhaps get involved. So when I look at a stock like SWKS and I see strong seasonal, weak technicals, I go with the technicals. Notice when we're looking at the seasonal information here, there's not 100%. There's nothing here telling me that I'm going to get a 7.4% return and it's guaranteed. This is just history of what's happened in the last 20 years. No guarantee that's what we're going to see this year or next year or the next 5 years. So while I think history does give us some things to consider, I would pay much more attention to what's actually going on in the charts. Okay, we got a couple more stocks that I want to go over here. Let's take a look at some of these others that tend to do pretty well in the month of August. Autodesk. Autodesk, looking back over the last 20 years, it's gone up 74% of the Augusts, and it averages going up 4.8%, which outside of November's 8.4% average gain, it is the best month of the year for Autodesk. So that's one maybe to consider. Look at the chart and decide whether or not that's something you might be interested in. Two stocks that kind of fall in the same space like August. And the first one here is ATVI, Activision. It's gone up 68% of the time in August, averages 5.7%, which trails only May as the best month of the year for Activision. And in that same space, we got Electronic Arts, EA. And when you take a look at EA and you pull this back 20 years, August goes up 74% of the time and averages going up 5.6%, which also trails May. So May and August, might want to mark that down on your seasonal calendar. Those are two good months for both EA and Activision. eBay. Let's pull up eBay here. And I've got a couple of stocks that don't do so well in August. And I'll pull those up in just a second. Looking back at eBay, you can see August and September. I wanted to point this one out because we just got done talking about how the market tends to be really weak in August and September. And yet these are two of the best consecutive months for eBay. 63% of the time goes higher in August, 68% of the time in September, and it rises about 6.4% over these 2 months. A couple of stocks maybe to consider that tend to be weak. Let's go look at JB Hunt. This is a trucker. August averages down 4.2% over the last 20 years, and it's only risen 21% of the time in August. So August, very weak for JB Hunt Transport. And T-Mobile, let's pull up T-Mobile. Well, I wanted the seasonal. Let's do the seasonal. And over the last 12 years, doesn't go back 20 years, but over the last 12 years, you can see averaging going down 7.9%, worst month of the year for T-Mobile. And actually, I will tell you one more. This is CSX because we did talk about this earlier, being strong technically. But from a historical perspective, you can see that August does go down 2.7% on average. September goes down another 2%. And these are the 2 worst months of the year for this particular railroad. So technicals look good. I wouldn't ignore that. But just keep in mind, if you start to see breakdowns, August and September are not historically great months for CSX. So let's pull up a quick recap of what I just went over. On the seasonality report for August, you can see the monthly index ranking, talked a little bit about leading and lagging sectors and industries, and then gave you a few stocks to consider. All right, let's go ahead and pull up that poll, Mary Ellen, because, again, we mentioned this at the top of the show, but we do have that little company, that little technology company, Apple, that is going to be reporting after the bell today. And we can see we've got 171 people responding. And the top answers, 30% say they'll beat estimates easily. 30% say they don't have an opinion. 21% says it doesn't matter. Apple and the market are going lower. And 20% says they'll come up short or they're warned. So pretty even distribution of votes here. Which one would you vote for?
Oh, that's a great question. I think, can I have two?
No, everybody gets one.
Oh, okay. Because they very well may come in and beat estimates. Analysts have been rising their estimated their thoughts for the earnings, but I'm not sure that Apple is going to really shift the markets significantly, just because they're not the powerhouse that they once were, and so.
Okay, fair enough. We got about 45 seconds. I'm going to go with it won't matter. And not that I think the market's going a lot lower, but I'm not excited about the market in August. And we're seeing rotation. We're seeing some of the software stocks, technology move lower. We're seeing other areas of the market pick things up. But we've had a number of companies come out and report pretty good numbers, and they've struggled since earnings. And I think Apple is going to report good numbers, but I'm just not sure it's going to matter.
Yeah, that's another good point. I mean, we saw Google and it initially popped on the numbers, but has come back in since then. And same with Amazon.
Yep. No doubt about it. All right. Well, you can see our upcoming schedule. Got a lot of good stuff coming up, but please don't forget ChartCon. My gosh, next Friday and Saturday, a great lineup of speakers, everybody talking about risk. Sign up now. Do not miss it. Do want to thank everybody for stopping by and being with us today. Please remember to complete that survey as you exit. Mary Ellen and I would love to know what you thought of the show.
Sure.
A couple of shows. And we do love to get your feedback in general, what you think of Market Watchers Live. Market Watchers Live airs 5 days a week, Mondays through Fridays from noon to 1:30 p.m. Eastern Standard Time. Have a great Tuesday afternoon, everybody. Let's watch Apple this afternoon, and we'll see you back here tomorrow. Happy trading.
Take care.
Volatility is back and interest rates are rising. With the markets headed into uncharted waters, ChartCon 2018 is here just in time. See how the experts are protecting themselves and watch live from the comfort of your home or office as they reveal the risk management strategies they use to stay profitable in any market. Plus, you'll get complete video recordings to watch on demand for years to come. Join us at ChartCon 2018, streaming live August 10th and 11th.